Hello, chart watchers, and welcome to this Decision Point show for Friday, January 4th. It's already the 4th, with your host, Aaron Swenlin. And I do have a special guest with us here today, and that would be Carl Swenlin, my father. So he'll be joining us. How are you doing today, Dad?
Very good, and greetings to everyone.
Yep, I know everybody's really excited to hear from you. For those of you who are just now joining the show for the first time, I welcome you. And for our Decision Point faithful, I welcome you back. So let's get started. We do have a lot to cover here in a very short amount of time, and we want to get as much in as possible. So we're going to be going over the Decision Point scoreboards, and of course, we have our special guest here, Carl. Monthly charts, we're going to look at and give you our 2019 outlook. We're going to look at the large caps. We'll certainly be spending the most time on the S&P 500, but we'll probably give a quick peek at the other large caps as well. We'll look at the big four, those monthly charts, and give you our ideas about what might be happening for 2019 there. We'll go over our decision point indicators, the climactic indicators, the short-term indicators, the Swenlin trading oscillators, and then our intermediate-term indicators, the ITBM and the ITVM. And then as a bonus, since we do have Carl here, we're going to look at a couple of parabolic moves, price moves, and then we're going to go over the PE range chart that you're very famous for, Dad. Everybody loves that chart when you come on Market Watchers Live. So looking forward to looking at that. So all right, well, let's see. Let's get ourselves into some charts. I think we might as well get that going right now. Oops, sorry. Lost my arrow. Okay, here we go. All right, so let's go ahead. We're going to start. Let's just jump right in. I'm going to show you our, first I want to show you the decision point scoreboards just to start off. Since we last talked right before Christmas, we did see on the monthly chart, we got that negative crossover for the PMO signals. And when you get a PMO negative crossover on the monthly chart, that is a long-term sell signal. And so now you can see that our boards are completely red and neutral. And one of the things I pointed out, Dad, was that on Market Watchers, I went back and I looked at what the scoreboards looked like on January 5th, and they were all green, completely green on January 5th. Of course, that was near the top of that parabolic price move, but boy, what a difference a year makes. All righty. And then here's our sector scoreboard. I just wanted to point out we continue to see the long-term trend model buy signals on consumer staples, healthcare, and real estate, as well as utilities. And those are our defensive sectors. So it makes complete sense that that's where we're seeing some of the strength. But I have to tell you, when I looked at those charts for those for all four of those, the long-term trend model buy signals are actually in jeopardy for most of those. So if we have time, we'll probably take a peek at those just so you can see what I'm talking about. Another reason to continue to look at this as a bear market situation. All right.
By the way,
oh, sure.
The neutral signals are basically soft sell signals, meaning that when you go from a buy to neutral, you're going from long to cash or fully hedged. So it's not a neutral outlook per se. It's just,
right.
It's not bad enough to make it a sell yet. It didn't meet the criteria, but it's definitely a negative.
Okay. Yeah, and really the main reason we're getting those is when you get those 20, 50-day crossovers above when the 50 is above the 200, when you get those 20, 50 negative crossovers, we choose to believe when, the 50 is above the 200, we're in a bull market. So we don't want to go into a heavy sell signal, so we use a neutral instead. Excellent.
Right.
All right, so now let's go ahead and get back up there. Let's go ahead and look at the S&P chart. That, I think, is really where the interest probably lies here. So let's go ahead and start up with that. Ready. All right. Like I said, since we do have Carl here, I'm going to have him do a lot of the talking on these monthly charts. So people want to know your opinion. They know mine all the time. So.
Okay. Well, you can see the PMO sell signal, which is really, they're deadly. You know, they're not 100%, but boy, when the monthly PMO tops or does a crossover, it's time to head for the hills.
Yeah.
But you see the worst downside that I would project, and I'm not predicting, I'm just saying as a target, a downside target would be, it's almost 60% down from the top, and that's the line running across that 2007 top.
Right.
Then there's the consolidation in 2015 and 16. That's at the bottom and the top. Those are two other really good-looking areas of support. So.
Mm-hmm. Yep, totally with you there. And I know one of the things I did notice. In fact, let's go ahead and I'm going to show this because you were talking about how deadly these signals can be. And one of the things I'm going to be talking about, we're doing a 2019 Outlook video. And one of the things I'm going to talk about, so you guys get a quick preview, is the amount of sell signals that we do get on the PMO. So between 1936 and 1978, how many years is that? Over 40 years, we had only 12 sell signals. And you can see that in general, they lined up right with corrections and or bear markets. You know, even in this case, it was just a volatile time sideways, but we still ended up in a place we did not want to be. And then if you look at 1978 or 79 through 2016, there were 9. So when you add that up, we have only 21 sell signals over 90 years. 21. So when we get one, like we just did at the end of November for the S&P 500, as well as the S&P 500, 100, and then also the NASDAQ 100 also ended up with sell signals at the end of November. And of course, the Dow just joined recently. So interesting stuff.
As a practical matter in real time, I like to use the PMO direction changes, sort of get myself set, because you see the PMO tops, you should really be looking for some opportunities, the downside or opportunities to get out.
Mm-hmm. As soon as it starts to switch that direction. And I know, we also want to watch it to see if it switches back to the upside, because that could also be giving us, a hint that we're looking at possibly the end of, either, at the end of the correction, more of a cyclical bear market.
Yeah, direction changes are much more frequent, of course. So you've got to, manage them more tightly.
Right. And it's an excellent place to look. And again, when you're looking toward 2019, that's what we really want to look for, is we have the PMO sell signal, but what we need to watch for now going into 2019, and you can see it even more clearly here in the thumbnail, the acceleration downward. We want to start seeing that decelerate at a minimum. And if we can start seeing it turn up, that's when hopefully everything has shaken out and we're done with a bear market situation. So, all right, let's go ahead and look at the monthly charts for the big four: dollar, gold, oil, and bonds. And like I said, Carl brought his charts, so I want to definitely have you talk to them, and I will add my 2 cents.
Yeah, I'm looking at a little deceleration on that PMO, and it just did a crossover, so it's in a buy situation now, but I'm a little nervous about it, especially when I look at the shorter term charts.
Right, on the dollar, I can actually pull one of those up. Yeah, right now I'm sort of lukewarm on the dollar. The expectation, of course, is that it's going to really fail here, with the bear market situation. That's my understanding. And, we should expect gold to do well, typically in a bear market situation. But, the dollar's kind of hanging on right now when you look at those short-term charts. I think
if you draw a line from the April low up through the September low and on, you're basically going to see a higher.
Okay, I want to get it dark so I can see it. There we go. All right, up to here.
Okay, and then if the August top, stretch that one you have. Yeah, that one, stretch it down.
Let's get it up there.
I'm trying to you can see it now with just the short line at the top, but it's instead of a rising channel, you have the rising wedge, which has a better chance of resolving downward than
exactly
than upward. So
yeah, I mean, like I said, I've been pretty lukewarm. I haven't been as bearish as some people on it. But yeah, you can see that wedge more clearly right here if I can get my drawing these properly. All right, so yes, we, in the longer term or in the intermediate term, the dollar should fail. I mean, this is, I think, probably the area right here is that top in August. I mean, if we break down below that, of course, that would also, get us down past these lows that we've had at the end of December. And that certainly, I think, would be a bellwether to tell us that the dollar's finally going to dive a little bit, because we don't even have a PMO in negative territory yet.
Nope.
Okay, let's go back and look at the next. Okay, everybody keeps getting that glimpse of that chart right there. Gold. So what are you thinking about gold? I know you're concerned about the dollar, of course, and of course that generally means good news for gold. I think the chart looks pretty good here.
Yeah, I think it's catching hold again. We've got a bottom above a bottom, and we've got to get through that resistance up around 1400. But the daily chart, and we don't have to go to that, but it had a small parabolic on it, and which broke down today, and I think we'll see, a little pullback and then resumption of the advance.
All right. I know this is one of the few things I am looking at as a possible place to sit. Right now, I'm in cash completely, and so looking for places to maybe park it a little bit. That's one of the areas I have been looking at pretty closely. I haven't pulled the trigger yet, but it's certainly one of the areas I'm looking at. All right, this is pretty ugly for oil.
Yeah, it looks like it's headed for about 30, 32 or something like that, and probably lower. But what's really came through to me last week when I wrote the weekly wrap is that it's since the 2018 top, oil's dropped 40%, and that's just got to have a terrible impact on that industry, and then that has ripples that go out, in terms of support to the oil industry. So I'm really concerned. Is this a sign of deflation headed our way?
Right, exactly. And I know that's part of the concern of, what's going to happen with 2019. I mean, a lot of people are calling out the economy as, interest rates and all of that. Recently, I've heard a lot of people talking about the credit crunch, if that could be a problem.
Absolutely. And of course, we see the PMO, monthly PMO is topped and not a crossover. So there's probably more grief to come.
Yes, I have to agree. I hate to be the bearer of bad news all the time. It's been really rough on market watchers. Tom is pretty much a perma bull. He's finally turned it over and just given up the ghost and saying, yes, okay, it's a bear market. But I've had to preach bad news for so long. I'm not looking forward to doing that more in 2019, but I suspect that's what we're going to have to do.
I'm afraid you're going to have to.
Yeah.
You notice here on this bond chart, you've got, this is a 30-year bond, and you've got the parabolic that came up from around 2011 and finally broke down in 16. And
in a big way.
All the way back to that rise trend line and bounced off of it. Look at that, Greg Morris.
Yes, we joke because Greg Morris says that trend lines, the only ones that matter are your horizontal support and resistance. He makes fun of us for drawing all these trend lines.
I have to say I'm adjusting my attitude more in that direction, but there you go. The trend line is fairly reliable there.
Absolutely. I want to just take us really quick to the monthly I have for bonds as well, because there's one thing I wanted to look at here. So I know we both were talking about head and shoulders, remember, that was forming on this chart. And, my thought had been, as I know yours, is that we got the breakdown and we should expect a move, the size of this pattern, a measured move. And it should have been dropping way down here. But as we can see, as you had drawn in too, it managed to bounce off of that rising trend line. And now for me, when I look at chart patterns like this, when I have like certain criteria of when I decide, I mean, I don't know what the textbooks necessarily say about this, but for me, with a head and shoulders, as soon as I see either a declining trend line from the head to the shoulder being broken to the upside, or of course an upside breakout above the neckline, that pretty much disintegrates that pattern. So I think that, yeah, and between that and the PMO turning up now.
But how old is that bottom? That was last
year.
Yeah, that's been in effect. So yeah, that it's looking
there you go,
bullish at this point.
Mm-hmm.
I have a chart of the 50-year chart of interest, bond interest.
Let's go over there. Very good transition. Okay, here we go.
Keep teasing.
I know. Keep doing it. Keep doing it. All right, here we go. So on yields, of course, it makes sense. They travel pretty much opposite directions for obvious reasons.
Right. It's surprising that we had a breakout and yet it pulled back inside below that declining tops line. I think this is going to prove to be just a short aberration. I think that ultimately it's rates are headed higher. I mean, that's what I believe at this point.
Mm-hmm.
If we really get hit with deflation, well, that's just, it's hard to think. But see, we got a PMO top, monthly PMO top, and no crossover yet. So that still has a chance to reverse itself.
Yeah, I mean, and fake outs do occur. I mean, you can certainly
absolutely.
For example, back here in 96, we got the turn down, but before it crossed over, we got it to go back up. So excellent. All right. I guess we should probably quit teasing them.
Okay.
And let them actually see our your PE range chart. I know this is, again, very popular chart. So here we go.
Yeah, I'm going to be releasing an article on this this weekend, so with some more details than what we'll be able to cover here. But the red, blue, and green dotted lines define where the index would be if it were overvalued, which is the red line, fair value at the blue line, and undervalued at the green line. And we finally corrected back. We were way out of way past overvalue earlier or later last year. And this pullback has got us back within the bands, back within the normal range, but it's got a PE of 19, so it's still overvalued.
Right.
The little hash marks on the right-hand scale are where that's the projection for 2019 third quarter. So as you can see, the index is well within those borders, and it could be getting back to the fair value. Of course, a lot of this depends on what the market does, and then of course how earnings come through by the end of this year. We'll just have to see. But right now, I don't like using forward earnings, but you still have to have a question in your mind about where it is in relation to what they're projecting.
Mm-hmm.
But anyway, as I've mentioned numerous times, I put this chart up about once a quarter, and saying that when it gets way above the red line, it's just not likely to stay there forever. I mean, it's really likely to pull back.
Mm-hmm. Yeah, you could see it's during the .com era.
Yeah, that was probably the most egregious overvalue that I can recall, but it was like something like a PE of 50 on the S&P 500. I mean, it was just ridiculous.
Yeah, it happens for sure. So right now, if we project upward like you're doing here, but there's certainly possibility for it to turn back down. Am I right there, or is this what you're getting from data?
Well, my belief is that the market is going to correct back into that band area. We don't know where the bands will be for sure at the end of the third quarter, but that's sort of where we are. So it would be good if we corrected back down and got closer to, say, fair value and even undervalue. Undervalue is a great time to be buying.
Right.
I think it hasn't been undervalued since 1984, I think.
Oh my goodness.
Yeah.
Wow. Can I take this back and see?
No, you can't.
No.
Well, I guess.
Oh, we can see.
Yeah, I guess you could.
Let's try. All right. Well, I have to do it manually. I forgot. So like 1980?
80, yeah.
There we go. Yeah, that's when we finally saw that.
Let's see, 84 is the last time it was, and it's been,
Ever since, it's been almost irrational exuberance.
Yeah, right.
Well, and I think, this is one of those questions that come in a lot, and just talking to, my friends and lay people, they don't understand. They're like, but earnings, jobs, business, everything seems to be going so well. Why should we expect the market? Why are we going into a bear market? I don't understand. Everything says it's great. And I think this chart really says it. if it's overvalued, it doesn't really matter.
That's just one thing. And they have to remember, they should remember that what you hear is always the best case, except when the worm turns. Now, everything was wonderful going up into the all-time high, and then since it started down, we're hearing all kinds of reasons why it should be going down.
Right.
The what do you call it? The reverse trend is underreported. They always report on what are the reasons it's going down, what are the reasons it's going up. The reason it's going down is we have the debt bomb, we have the overvaluation, and I can't think of the other major reason. But they are sitting out there. They have been sitting out there, waiting to grab us, and now it's coming in.
Yeah. All right, and then let's look at those parabolics. We have just a few minutes.
Okay.
Apple, I think, is a great one. I didn't actually size this one. This
is great. The size is great. The size is great. It will distort it if you try to make it wider. Okay, but you can see Apple is repetitive. It does parabolics, and it breaks down and has very heavy corrections. 64% in 2008,
right?
45%, 32%, and right now it's 40%. It's corrected down 40%, and could be. My target was that line drawn across the 2015 top, so that's kind of a wag on my part, but it could get worse. But parabolics can collapse back to the basing pattern, which would put it back around $20. That is not going to happen with Apple because it's much too strong a company. But if you've been listening to the news, it's really wonderful. As it was going up and became $1 trillion company, everything was wonderful about Apple. And also, it's been going down. We're hearing everything that's wrong with
Apple.
Apple.
It's the same idea.
Never heard of it. And it's just don't listen to them.
Yeah, exactly. And honestly, that's 2017 for the market. It's just a similar thing, and that's why we just had to hit it really hard. But all right, well, I can't believe it. The show is almost over, and I really appreciate you coming in. I know that you're busily writing the weekly wrap, and you've also graciously accepted the challenge to do Chart Watchers as well this weekend. So I appreciate you taking the time, as I'm sure our viewers have too. All right. So in closing, I just want to thank all of you for being here today. We'd love to get your feedback. So you can either do that in the survey that's underneath the viewer, or certainly feel free to send me something on Twitter @_DecisionPoint or email. Love to hear it. We do air the Decision Point show every Friday at 1:30 p.m. Pacific time and 4:30 Eastern. So I'll see you back here next week, and happy trading.